Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. After having posted a very nice gain the last 2 weeks of December, the market now finds itself in a position where 2 standard deviations below the point of control had been a little bit much for this market to get through. The last 2 times that this market tested the 353 half number, the market did find stiff resistance and has moved down from there. Currently, we're looking at a move that is a profit-taking move, and if this market's able to find support near where it was at before, we think another nice leg up could still be in the cards for corn. Right now, the market essentially has been moving sideways ahead of the WASDE report that's due for Friday, and we anticipate that the market will continue to move sideways for the next few days at the very least. The recent low that was posted was right at the 347 half number, which is the 360-degree cycle mark. And just below that, in the event that the market does move down in conjunction with the WASDE report, we're looking at potential support down below at the volatility-based support range near 340 to 345. And if it breaks below that range, then we're looking at something in the neighborhood of 337 to 340. In either case, we believe that the market is perhaps poised to continue moving in a low volatility range over the next few days until it's finally able to break out of the sideways movement, upon which the market can finally find some legs to the upside. The May contract's moving in a similar fashion, where the previous low is exactly where the market came in to retest on another low. It is rare that a downside movement would terminate at a double bottom, so it is possible that we could get one more slight move to the downside that breaches this area here, that comes in somewhere about 353 to 356, and upon reaching that area, we could see some very good support there from which the market could bounce. From this perspective, we can see that the cycle 360-degree mark falls at 351, and we do have our volatility-based support band coming in right in that range of 349 to 353, consistent with the levels we just previously discussed. From here, the market can finally find some legs, and if the volatility bands are able to start making its way up, upon breaking this trend line to the downside, which we believe is an important area for this market to get through, this time price vector itself would be an indication of a change in trend once the market's able to break through this area. Soybean futures are moving very much in tandem with expectations. The market came up and tested our 996 half resistance level, and from there the market is moving straight down. It appears that the movement that we're seeing now can potentially find short-term support near the 965 area, but in all likelihood, we anticipate that a move that is 2 standard deviations below the point of control at 952 half is perhaps where this move down could terminate. If you recall from previous sessions, we had our 980 number as our line in the sand number. And if this market was not able to hold above 980, we believe that this market was due for a very big potential run to the downside. That 952 number happens to coincide with previous lows. And now we're looking at volatility-based support coming in the neighborhood of 929 to 939. Now, we also do see that the volatility bands have started to make a shift to the upside, and in doing so, it reaffirms for us the possibility of 952 being the area where this market finds a very significant low. The March wheat contract has been very consistent with expectations. After a very nice move to the upside, there was a bit of small profit taking that occurred for about 3 to 7 trading days, but the market has since made its way back up, and it appears that we have very good support at the 424 number that we have been discussing on several occasions. The first time we talked about the 424 was when we found support way back about a month and a half ago. After having found support there, the market finally broke, and we believe that the market have a nice breakdown to give us a final low in conjunction with the divergence that we had discussed previously. Upon making its way back above this 424 number, we then believed that potential strength was ahead, and now the market's made its way up, almost touching our near-term target of 445, giving us a pullback, and now it appears that it may be on its way back up again, but that remains to be seen. The fact that the pullback was as shallow as was posted suggests that this market could very well have some good legs ahead of it, and upon being able to get above the 445 number, the next target objective would be somewhere in the neighborhood of 466 in the not too distant future. Perhaps part of the difficulty as to why this market on its first attempt up was not able to quite get to the 445 was volatility-based resistance overhead. But upon being able to get through this area again, we do anticipate that a nice move to the upside is possible. We have one additional time factor for this month that we're looking at that lands at about January 19th. And so if this market continues to move up into this timeline, we could see another corrective move before another leg up to the upside. The US dollar is giving us exactly what we've been looking for. Some may have thought that the recent move to the upside that came off of volatility-based support could have had some legs, but our bias the whole time has been to the downside potentially. After the market came in and did touch volatility-based support here, we saw a bit of a consolidation for about 5 to 7 trading days. The market made its way up to test the 92.5 number and has since started moving back down again. Our previous price objective was for the market to potentially come in somewhere in the neighborhood of $90. And as we take a look at the longer-term weekly chart, we'll be able to see where, in fact, this market looks like it could very well terminate. As has been mentioned before, we can see where the market put in its potential A or 1 leg from the downside initial thrust. We now have our B or 2 leg up above, and depending on how far down this move to the downside does go, will determine whether or not this is simply an ABC corrective move for a reversal back up to the upside, or if there's continued weakness to the downside, this then becomes a 1, 2, 3 or an Elliott 5-wave pattern, or at least the start of a 5-wave sequence where we're looking at simply the first 3 of the 5 major legs. If this market comes in and is able to break below the $90 number and trade somewhere in the neighborhood of 88 to 87, then we would change our position from being an ABC correction to a new bear trend to the downside where the US dollar could find even greater weakness in the coming months. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next time.